Welcome to Navigating Now, real talk for rocky times. A Pete the Planner CalmCast.
Good day, everyone. It is May 27th, 2 p.m. Eastern, because I'm here, you're here, and this is where we meet twice a week during these times for 10 minutes on Tuesdays and Thursdays. It's good to be with you on this show, Navigating Now, which is simply a
CalmCast.
What we do is we take 10 minutes to go, what happened since the last time we spoke in terms of the market and the economy? And what are three things that maybe you could invest knowing some time in? Today, we're going to talk about those three things. Technical analysis. Oh, charts are fun. So we're going to talk technical analysis, leading indicators, which we've alluded to a lot over the last several weeks. And then cash flow. I'm going to give you a different note that you haven't really thought about on cash flow today. But first, a lot happened. We last got together checking notes on, looks like the 22nd of May. And since then, President Trump has done a few things that have impacted the markets and just the general sentiment around the economy. First, he said the EU, the European Union, had not done enough to come to the table to negotiate a trade deal. So on June 1st, he was going to put a 50% additional tariff on all of their exports. And then a couple days later, he said, nope, I'm going to pause that now until July 9th. So that caused a little bit of an issue. And as of today, the markets have reacted positively to the fact that he's waiting till July 9th. I'll also note a couple different things. A few global leaders such as Spain, Canada, and Japan, they're putting in government intervention supporting their economies with investments to better withstand the ill effects on the tariffs on them. So that is interesting that some domestic fiscal policy is being impacted by those three large countries. More to come on the horizon. Other bit of news today that should meet your attention. Consumer confidence numbers are up. Yeah. Look, I don't know if I'm surprised. I'll just say this. Consumer confidence is a super, super important thing. It's a leading indicator, which we're going to talk about today, as to what we should see on the horizon. Most consumers, according to these numbers, feel pretty good and have not felt the impacts of the tariffs yet. They might be scared by the tariffs, but they've not felt the impact, and they have confidence in the economy going forward. Should they? I don't know. It's wildly personal. But it's with that, let's go ahead and jump on into technical analysis. Technical analysis, we have talked about fundamental analysis on this program. We talked about things like earnings per share, price earnings ratio, beta, alpha. These are different ways that an investor, a research analyst more specifically, or an investor doing research, can look at, do they want to invest in this particular company? So there's some numbers, some ratios, some best practices. When you think about your body, think about your height, your weight, your waist size, those sorts of things. That's more fundamental analysis. Technical analysis, which is what we're covering today, it's all about the charts, baby. It's like just looking at an EKG and going, that's all I need to know to make my decision. And from a stock perspective, it can be pretty interesting. Okay, so here's how I might think about it. It definitely is more art than science. It is trying to predict the future based on how the present crowd is reacting to a stock. So if you look at a stock, whether it's over the course of a day and it's trading, it's buying, it's selling, it's doing these things, over the course of a month, you get that like a little squiggly chart. And what you can often see are resistance or support points. Okay, so resistance is that it can't go above a certain level. It always bumps right up against it and then comes back down. Then it goes right back up to that, what's called a 52-week high, which we talked about a couple weeks ago on this show. That is resistance. It's not breaking through the resistance. On the other hand, the bottom, which we were talking about as a 52-week low, that's called support. It's to say it's just not bopping below that number. And when you don't look over a 52-week period, but you look over the course of a few weeks or days or even months, you can start to see patterns. So what a technical analyst does is they say, okay, how is this stock, this company viewed by other investors, and how can I read that information to make a decision as to whether I want to buy or sell it myself. I've oversimplified it, but that's more or less technical analysis. Let's move on to our economic lesson of the day, which is leading indicators. I quite literally talking about this since episode 1. There are certain numbers, metrics that come out about our economy that are a leading indicator that says, we're going to give you this number now, and this number should inform you as to what the overall economy is going to be doing over the next several months. And there's what's called a laggard or a lagging indicator. A lagging indicator is something that the economy's already did its thing, and then here's a note that says what's going on because of it. So a leading indicator might be something like new home starts. Okay, so you think about home sales and people wanting to build a brand new home. Filing for those permits is a leading indicator that some economic activity is going to occur. Or an unemployment claim may suggest that the economy may be less productive and not be able to spit out the level of gross domestic product that we expect. So you kind of got to read both, right? You got to understand leading and trailing or lagging indicators. I would say right now, consumer confidence, which we talked about earlier, is definitely a leading indicator. It is suggesting that things are good according to consumers. A lot of the things we've been talking about over the last several weeks, I would say, are primarily saying that there could be a recession ahead. If we had to weigh all the things we talked about, which is the reason I did this entire series, I would say more than 50% of those indicators are saying recessionary times are ahead. However, it does feel like time and time again, we're seeing some indicators that are saying we might just be okay. I hate to always say this, but I always feel like I just need another 2 weeks of data. I literally say that about every aspect of my life and existence. Anyway, let's talk about personal finance, because that's what you can do with this whole thing. Let's talk cash flow. A business understands cash flow because they have to. And if a business does not understand cash flow, they very quickly go out of business. It's the money coming into your system and the money exiting your system. So your income and your bills and or obligations. Now, if on a regular basis you have more money coming in than going out, that's positive cash flow, and that's a great sign for you. That is a sign of strength and a sign of flexibility. If you have more money going out than coming in, that is a sign of weakness. And, there's a lot of different ways to do this, but look at your bank statement. How much money went in? How much money came out? Is the month lower at the end than it was at the beginning? Kind of look at those and you can say, what's going on? Now, the other element, I promised you something you don't think about a lot here today, and here it is. The other element of cash flow, not just money in, money out, is timing. Timing. Have you ever had a payday on the horizon 2-3 days away, and you're like, I actually need to be getting paid today because my bills are due today? And so what ends up happening is that without timing, if you look over the course of a 30-day period, you may see someone that has the propensity to be cash flow positive, but because their timing is off, it is hard for them to meet their obligations. Businesses master this with a credit line. And the problem is, if you're not in tune with how all of this works and you try to use your credit card to fix your timing and you really don't understand of how cash flow negative or positive you are, that's how you get into credit card debt. So if this is you, if it feels like you got enough money, you just don't have the right amount of money on time, and trust me, you'll know if you feel that way. It's a timing issue, which is to say you can reset that in a week, if not a month, by spending a little bit less than you normally would and letting the time reset so you have the money when you need it. One good way to do this is simply count your transactions. Count the number of transactions you have over the course of the week, and it can help with that. That's all we have time for today on the
CalmCast.
Next episode on Thursday, market cap, unemployment rate, and needs and wants. We will see you.